Hi, I'm Peter Rose, founder of Longwood Currency Trading. Don't change your Forex trading methodology. Stay with what you feel that you have worked out in your mind as far as how you trade. I don't believe in systems. I believe in methodologies. A system is when you're looking for an engulfing candle pattern or a golden cross or London Open or something. Those are systems. And systems are prone to fail because they're not based on order flow. They're based on temporary price action that's created by order flow that signals certain things are happening. But those same things are so variable, not only in their periodicity, but also their amplitude. If you know anything about mathematics, periodicity and amplitude have to deal with wave propagation and random motion and all that other sort of crap. And the Forex market, as one of the most complex of the financial markets that there is, can be modeled based on random calculations, Brownian motion, and all kinds of stuff that you don't need to know anything about. Just understand the difference between a system and a methodology. A methodology is when I'm looking at price action and I see that price is expanding upward with the candle size a little bit larger or markedly larger than the previous 4 or 5 candles, it indicates that something is going on. An order flow is changing underneath that in an upward direction. And so you look at that and you go, does this movement meet the criteria for me to get into the trade? Now, that criteria I've simplified in each of the 3 phases of the life cycle of a currency position, which is my rip against the software engineering process of the software development life cycle, the SDLC, which is a process of solving complex problems by breaking them into solvable pieces and then ordering those pieces in a sequential order and on and on. I've explained that a zillion times in the 420 some odd videos that I've done so far to date. This is early July of 2024. Regardless of that, you notice that price action is changing, that there's a increased candle size, which is a measure of momentum, is changing. Now, it is insufficient that you just say, oh, I've got rising candles, I'm going to go in. That's insufficient. You don't have enough confirmation of your methodology that's going. You can't just have a methodology that says when it goes up, I'm going to buy. In effect, that's what you do, but the corollary to when it goes up, and here are some conditions, then I'll buy or sell or whatever it is. But the life cycle of a currency position has 3 phases to it: entry analysis, position management, and exit methodology. And each one of those, I've crafted a rule that has from 4 to 2 conditions. The entry analysis has 4 conditions because it's the more complex, and position management and exit methodology both only have 2 conditions to be met in whether you're going to act on them or not. That makes things simple. So that's a methodology. A methodology takes what's happening right now and balances it with your experience, which is based in your rules and your observations and your trading metrics, whatever those metrics are that you choose. I have 4 that I choose. Win-to-loss ratio, I talk about that all the time. So the methodology is something that you do that builds knowledge and experience in trading, whereas if you're following a system, you might as well be a dog that responds to a treat that's offered to him. You're not really learning how to trade, and the systems break down again over time. If you don't think that, then try trading one of these stupid robots that's out there that you can buy. most of the robots, in order to develop rules that the robot can understand, are based on trends. And then the anomalies of a chatter or a range-bound motion tend to screw them up pretty well. The AI systems that are coming out are going to be better at that. But would you risk $100,000 of your money against some AI? So I don't think so. You might get away with that, risking $1,000 of your stupid $100 account. Somebody's telling you to take the $100 to $600. That's like me saying, take $100,000 and make that $600,000. You go, well, that's pretty hard, eh? But going from $100 to $600 doesn't sound like it's a big deal. And it isn't if you combine that with 500 to 1 leverage or 200, even 100 to 1 leverage, and some stupid system that you're involved in. Because those systems all, if you know how to mathematically analyze them, they require you taking more risk in order to fulfill the guideline of the system. All the folks that I see that are using these systems, they don't have a concept of what risk management really means. They think that risk management is setting a stop, which they don't do, but that's risk management. Setting a stop has nothing to do with risk management. Setting a stop may be the result of some risk management principles that you have in your methodology, but you're not going to find that in a system. And so once you get over all this crap that you see out there in video land, and you realize that you're not going to make 300% against your bank in 40 days or some silly thing like that, the trading is like anything else. It's like doing surgery on your arm. You don't just cut, fix, and sew them up. There's a process, and that process takes time. No matter how good you are, it takes time. Now, if you're really good, you can shorten that time, but there's a limiting factor on the amount of time where that becomes risky to the patient. So in your trading experience, as you're learning early on, you may be placing these trades and you're thinking you're very comfortable letting that trade run for 4 or 5 days with a set and forget method. But what you're not taking into consideration is how much risk management are you going to be able to apply to that trade once it's running and it goes up. You know, you're going to run it for several days and you're looking for 100 pips. ATR on a major currency pair, 80 to 100 pips, 120 pips. Okay, so you're looking for 100 pips, you're looking for an ATR win. So the thing starts going in your favor and it's up 20 pips and all of a sudden comes back 30. What if it keeps coming back? Are you going to hold that? Are you going to keep your initial stop? What are you going to do? If you don't have experience in trading, then you're going to simply take set and forget type advice, set it, forget it, go to work for 5 days. You can't do that in trading, and you can't do it in surgery or swimming or sailing or playing chess. But trading is an art, not so much a science, although you can bring science into it in order to further the art. An artist brings science into his art by what science tells him are the proper ways of mixing his oil paints together to form different colors, what kind of colors combine together bring another color, and how much of each color matches. If you've ever bought a gallon of paint at the local paint store, and they'll work up, take a scan of the little paint strip that you brought, and that translates into some mathematics as to what colors need to be added together and in what proportions in order to duplicate that color. But as an artist, you're simply looking for that color. That has nothing to do with art. That's the science of art. And so now, once you have used that science, you can use that color in a painting to bring forth your your sense of connection with the nature around you that you're trying to paint. And trading is the same way. I'm sorry, you just can't flap your arms and do you know, an engulfing candle pattern and expect to be successful. Go to your charts, and what are you going to trade? An engulfing candle pattern on a 5-minute chart? On an hour chart? What are the characteristics that are surrounding that? You can't just take engulfing candle pattern and march it around on the different time frames, because price action is random. The fact that you choose to look at a chart pattern of 15 minutes as opposed to a 1 hour has absolutely no correlation with the underlying order flow or the price action that's manifest by that order flow. What is in your thinking when you're looking at that? And not you, because you've watched this video 10 minutes in, and so you obviously are a step above the morons who cut out after 30 seconds. This is part of the education of learning how to trade, so that you can develop a methodology that balances your psychological background, your character, your personality as trading. Are you a better short-term trader, long-term trader? You want to fast and go and scalp, or do you want to run it out for a day or two? You have to match your methodology with who you are as a person. That's why when I teach somebody, I teach principles and not systems. Because you can take a principle and say, well, oh, okay, how would I apply this principle in a 5-minute chart as opposed to how would I apply that principle on an hourly chart? Because when you're trading, you're using multiple time frame analysis. You have to, because the chart that you're looking at has nothing to do with the order flow. The little breakout pattern that you're seeing on the 5-minute chart means absolutely freaking nothing in the 4-hour chart realm that the institutional traders are looking at. It really doesn't. So you can't trade based on that stuff. That's why I caution you about indicators and systems and gurus at telling you to trade it. It's okay to trade at 200 to 1, because if you get lucky, you can take a $1,000 account to $10,000 like that. Yeah, but you're not experienced enough to be able to do that. They can do that. You can't do that. That's what's going to take time. But because you're wanting to take the $1,000 or the $100 to 1,000 or 1,000 to 10,000 or whatever it is you want to do, that you believe these people, and you throw risk management to the wind and wonder why the money was lost. When you learn how to trade, and find somebody that knows how to teach how to trade, it doesn't make any difference whether somebody made $2 million or $20 million trading if they can't teach it to you. If somebody made $10 million, then they're teaching you Fibonacci analysis. Why would... There's absolutely no mathematical or physical correlation between fib numbers and price action levels. Absolutely none. The fact that they sometimes match up is totally random. They are not predictive in any way, shape, or form. And so that isn't part of a methodology. You can't get involved with people just because they made a lot of money. Doesn't mean that they know how to trade, or that they know how to teach you. Those two things. Do they really know how to trade, or did they get lucky? And number two, can they teach you? That's a tough choice, because it's very compelling what they say. How do you believe what they're doing if you can't duplicate that? If you're following this stuff, and I've taken courses before and read all the books and watched the videos, and I've tried to follow all those principles. The courses, they outline all this stuff. I couldn't make it work. I figured out later why I couldn't make it work, but that's all because I'm trying to replicate what they're doing instead of figure out what I'm supposed to do. I'm supposed to figure out how to trade, and nobody teaches how to trade. They all teach systems, indicators. It's Tuesday and it's cloudy, and so you do X, Y, Z. If you don't know how to develop enough trading experience to build that methodology, I don't know what you're going to do. When I work with someone It's over a 4-week period of time or so that we work together to try to understand what order flow is all about and what sorts of methodologies you would use to solve the 3 problems of the life cycle of a currency position: entry analysis, position management, and exit methodology. And how you develop rules that are condition-based, sequential condition-based rules, so you're not into a permutation matrix of decision-making. If you had 5 non-sequential conditions, you'd have 325 different permutations you could put those 5 conditions in. However, if the 5 conditions are sequential, there's only, you either get a yes for each one and you execute, or you get a no somewhere down the line and you don't execute. Man, I just don't get the complexity that these people are teaching. And the only reason that I can fathom that that's what they're doing is because they don't really know how to trade. They know how to get lucky. They know how to trade at 200 or 500 to 1 and roll that money forward. You know, if you take a $10,000 account and you lose it 3 or 4 times in this spastic journey to trade at 500 to 1, and finally you hit it right, you'll take that $10,000 account and you'll be at 6 figures. Yeah, I've done the math. It takes six winners. And that's all you need to do. Get lucky 6 times. If you're trading over 100 trades, there's not a significant probability, but a single-digit probability that you'll hit 6 losses in a row. But that also means you could hit 6 winners in a row. But if you don't have any experience to manage all that stuff, how are you going to differentiate between what a winning trade is and what a losing trade is? How are you going to do that? So I have a process. I have a whole course, a 130-page course for my advanced students. That's not part of the regular stuff that I teach. It's for advanced stuff, but it's 130 pages on process-oriented trading. I mean, it's not that it's that complicated. It's, you know, if I'm an artist, I'm looking out at the trees and stuff. It looks tremendously complicated. But to the artist, it isn't. It's a tree. What's a tree? It's a thing and some branches going off and you paint some leaves. So there are ways, principles that allow you to simplify all this stuff. And if you don't see somebody teaching stuff that's simple, but that makes sense, you can't just say, oh, I'm going to trade at 500 to 1, and when it's Tuesday, I go all in. I don't think that makes any sense, and I'm sure you don't either. However, when I present this stuff to somebody, it's in this sequential order. It makes sense. It all builds so that after the first process of learning is encapsulated, you know everything. Then the second process is, well, that's the what. Then the second process is, how do you apply that stuff into the real market? And the third process is, when do you do that as a critical thing? Once you understand how the what, how, and when fit together based on rules and conditions that are sequential, then you know how to trade. And once you know how to trade, you can look at your trading metrics and determine how good of a trader you are. And once you determine that you're consistent, which is a good trader, that you're consistent, doesn't matter how consistent you are, you might trade 300 times and make $1 a trade, risking $10,000 every time you trade, which is a really shitty return. But if you can make a dollar out of each trade all the way through, then that's consistency. Now the question becomes, is that win-to-loss ratio high enough? And correspondingly, is your average win value high enough? Then we can start working on putting those pieces together. It's a process of learning, and it's a process of developing that methodology. Once you, and whether you do it the way I'm talking about doing it, or you're able to do it on your own, and you feel that you have this methodology under you, why would you change that? You shouldn't. You see all these people that are out there, oh, we just improved our trading. We're going to release our newest trading process, our newest trading rules. Bullshit. That's why you have to replace them, because all of a sudden you found a series of events that they don't work. Why don't you learn how to trade? So don't quit your Forex trading because your methodology is giving you 6 losses in a row or whatever. You have to understand the difference between you don't know what you're doing and you're in a statistical downtrend. I'm in a statistical downtrend right now. It's like I don't lose every trade, but the trades that I do lose are inordinately high. And so I'm a net loss on my overall risk of double digits. So I've got to get through this period so that I can get back to not doubting the trading and the methodology. Well, I thought I had it last month, for example. I was I had some serious losses, and I was up then in the month of June. I was up 3.3% on my, and I said, well, that's pretty good. That's about half of what I would normally do on a monthly basis. So I'm starting to get the roll of that. I got a little overly confident and jumped in a little heavy in July, and here I sit in the swamp because I changed what the methodology tells me that I need to do, and I changed what my view of the number of losses that I'm suffering and the magnitude of those losses. So I know for a fact that once you have a methodology that works, it's not like a rule. Oh, this rule doesn't work, so I need to change it. Maybe you do. But if you have a methodology that works and gives you consistent results, you don't change the methodology. You ride out the tough time, and you don't change. I changed the methodology. I thought I could catch up by doubling up on position size. That didn't work. So I went to all in, all out on my full bank. And that didn't work. $10,000, gone like that. So that was going against the methodology. In my advice to you is, if you have a methodology that has given you consistent results over, let's say, a 6-month period of time, then you don't quit that methodology to make changes. You're just in a drawdown. Maybe you got a boil on your ass and it's upsetting you, or your dog died, or something is wrong, but all those things will pass. But the methodology should remain consistent, because that's what gives you consistent results over the long term. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.